You ever notice that every time you hand over your card, it's always either Visa or Mastercard? It's like Pepsi versus Coca-Cola, but then for credit cards. Today, we're finding out how they make their money, which one is the better business, and which card Warren Buffett would buy if he forgot his Amex at home. Let's dive into it. Let's start with the first plot twist. Neither Visa nor Mastercard issues any credit cards at all. That means they don't hand out any loans, they don't charge interest, and they're not going to run you down whenever you miss a payment. They basically guard the roads. They're like a toll road of the digital money freeway. Every time you go out, buy a coffee, go get gas at the gas station, or buy a PlayStation 5 or an iPhone you don't need, they're there to take a small fee. And almost every bank works with them, and almost every merchant works with them as well. And this creates the ultimate business model. They have no credit risk. They have access to a massive amount of payment volume. They are scalable across the globe. And they have insane margins. They basically make Apple look like they're running a charity. It's time to dive into the details. And to do that, we're going to be using our software, Marketdaddy.ai. Now, if you've never been here before, the software does all the heavy lifting for us and makes the investing process extremely easy. We always work from the same 3 questions. Is it a great business? Can we buy it for a great price? And can we reliably predict it for the future? We're going to start out with Mastercard. We have 3 questions we want to answer. Our software already gives an insight in how great value investors like Warren Buffett, Charlie Munger, Manish Prabhai, Peter Lynch would look at this company. And based on those 3 questions and the way these investors look at stocks and the global stock market, it's not a great business. It does seem to be reliable, and it seems to be a little overpriced. Now let's dive into it and see if we agree. The first question is Mastercard a great business? And if you are looking for a great business, you're looking for growth, you're looking for reliability and stability, and you want to understand where they make their money. Are they growing in that field? And are there any risks involved that is preventing them from making money? Now, if we look at growth, let's go to the charts. We can see that the revenue growth for a company the size of Mastercard is fairly good. They're growing about 12% year on year. That's what we like to see. So the growth is here. They also have good net income, and net income is the bottom line cash that can be redistributed to investors and owners of the stock, like potentially you and me. Their net income sits around, or it has increased by 15%, and it's relatively high. Their free cash flow is also growing. Cash is king, remember that. And when we talk about being a great business, we want to see growth. We also want to see stability. And stability takes the form of cash. A growing free cash flow provides lots of stability, and linking with free cash flow, we also want to look at their cash to debt. Ideally, you want to see a ratio above 1. This means they keep more cash on their balance sheet than they do debt. We see it's higher than 1. Perfect. Stability, absolutely there. Let's look at their ratios. I always like to look at the return on invested capital. This shows how much money they can make on every dollar they invest into their company. 44%, crazy good. And the way you can look at this, they can invest all their cash with a 40% return. Can you match that as an investor? Most likely you can't, otherwise you would be sitting in my place. And therefore, this could be a good investment because every dollar you give to them, they can reinvest it at a 40% return. Now, if we look at their margins, they have a really high net margin. This is what hits their bottom line of 45%. Really great. That's what we love to see. So from a business perspective, Mastercard is absolutely looking like a great and reliable business. So it's a check for me there. I think next up, one of the more interesting things that people always want to talk about is what's it worth? What should I pay for it? And what is the potential growth here? We use our valuation lab. You can use the valuation lab by filling in 3 scenarios and see where the business is going to grow and what's it worth today. Every investment is the price of all future cash flows. And this is how our valuation lab works as well. You can fill in the growth over the next 5, 10, or 20 years and see what kind of valuation you can come up with over that time period. And then you can, or no, you don't have to do that. Our valuation lab does it for you. You get to see what you should pay for it today if you believe that those scenarios and that growth trajectory for that company is realistic. Now, let's see if we can fill this in for Mastercard. We use 3 different scenarios. We have the best case scenario, the base case scenario, and the worst case scenario. We can apply a weight to all of these for a total of 100%. The best case, 20%. It's 20% likely that this will happen. For the base case, it's 60% likely, and for the worst case, it's 20%. Then they get all blended together, and you arrive to one single value of what the company is worth today. Let's say for the best case scenario, they continue their current growth trajectory. They keep growing their revenue by 18%. If they manage to do that, I'm willing to pay a higher multiple for that. So let's keep that in line. 264% return is a little bit crazy. I'm looking for 15% return across all scenarios. Now, your mileage may vary depending on whether you want more safety or whether you are willing to if you want more safety, you might be looking at different stocks and might fill in a different return here. Market average is about 8 to 10%. I sit a little bit higher. That gives me a little bit more margin of safety. You could turn it down if you want to be a little less on the safe side. If you invest mostly in growth stocks, I would turn this up a bit because there is a matter of uncertainty within growth. Now, if we look at the base case scenario, let's say they only grow about, what's a nice number? Let's say they only grow about 12%. Then I would be willing to pay 25 exit multiple. And I'm going to alter my best case scenario as well. I think a PE of 37.8 is relatively high for sub 20% growth. But I would be willing to pay well above market average, especially considering the size of the business if they manage to do this over the next 10 years. And for the base case, I'm willing to pay PE of 25. And that, let's say for the worst case scenario, they barely manage any growth. We pay a sub-market average PE of 10. Market average is around 15. We do it for 10 years based on free cash flow. Let's run the valuation. And we arrive at a value of $291, while the current price sits at around $500. That means you have about a 45% downside based on my scenarios and my assumption of the business going forward. The business at today's value is only worth around $300 while you're paying over $500. In my book, not a great price, not a great investment. Now, let's move on to the last question for Mastercard, and that's about, can we reliably predict it for the future? And if I look at Mastercard, I think it's very hard for them to go anywhere. I think they're a greatly reliable business. They have a lot of cash on hand, so if something goes wrong, they have fat on the bones to weather any kind of storm. And the question boils down to, do you believe in the future of Mastercard and whether they will still be around for the next 10 years? And I think it's highly likely that they will be around for the next 10 years. I think one of the bigger pain points for Mastercard, but this is also true for Visa, are the stable coins being handed out en masse right now. Those are digital forms of currency that could actually compete with the payment systems that exist and are created and held to the highest standard by Mastercard and Visa. I think right now there's no competition, but looking forward, I would be very interested to see how that development actually goes into the future. But overall, Mastercard, reliable business, relatively easy to understand, one of the biggest payment providers around. So I would definitely give this a pass for reliability. All right, let's move on to Visa. It's already on our watch list. And we're basically going to answer the same 3 questions and see if there are large differences between the two. Let's start off, is this a great business? Well, first off, as you can see, the check mark based on all the great value investors, it passes as a great business. Do we agree? I think if we look at the vital signs already on a quick glance with a ROIC of 31.4%, it's lower than Mastercard, but still very high. They hand out a little bit of a dividend. They have a earnings yield, free cash flow yield of around 3%. It tells you more about the price. Now, one thing I also like to look at when trying to understand the business is our due diligence. This is being done by our AI model, and it looks and reads through all the earnings transcripts of the last quarters and comes up with what the biggest challenges are of the company, where they make their money, and where they see growth. Now, you can read through this yourself over on Marketdaddy.ai. You can sign up for free and try it out for 7 days. I think one of the key highlights here is that their revenue growth is strong and it's consistent across all quarters. That's what we like to see. They are investing in innovative technologies and partnerships to drive future growth. Now, I would be interested to see what are those technologies and which partnerships are they investing in. And their extensive network and tap to everything initiative give them a significant competitive advantage. I always like to hear competitive edge, competitive advantage. That's something that really can set a business apart. I would be interested to learn more about tap to everything initiative. Now, this is the way I use Marketdaddy. I look through the company and find interesting stuff that I would want to know more about. Maybe there are some risks here that I want to do some extra research on. But looking at a glance, I'm first trying to figure out whether I can qualify this as a great business based on what I see. Because if it doesn't meet the criteria based on what I see here, then I'm not willing to invest any more time into researching this company. So let's dive into the question of whether or not we agree with it being a great business. Again, we're looking for growth. Revenue growth allowing around 11.3% year on year. Also great. Again, a little lower than Mastercard. Their net income also looking great. Their free cash flow also looking amazing. Return on invested capital. That seems to be declining. Their cash to debt also very healthy. A little bit of a decline. I think Mastercard was looking slightly better. They're buying back shares like crazy. I always like to see this. This prevents you from being diluted, but you actually get to own more of the business as they buy back shares. So great. From everything I'm seeing right now, I'm inclined to say it's a great business, but let's take a look at their margins. Their net margin is actually significantly higher than significantly. I might be exaggerating a bit. I think Mastercard was around 45. For Visa, it's about 50. Meaning they get to keep 50 cents of every dollar they earn. And of that 50 cents, they could basically give you all of that, or they can reinvest it in the business at a return on invested capital of 31%. Now, like I said, I aim at 15. They're outperforming me, so I would be willing to give them my cash. From a cash to debt perspective, they're also doing good. So yeah, this is definitely a great business. I think there are some slight differences between Mastercard and Visa. Mastercard grows a little bit faster. Visa has a little bit better net margins. Mastercard then had a little bit of a higher return on invested capital, but overall relatively similar. This qualifies as a great business as well. Now, let's look at the price. Let's go back to our valuation lab. We take the same scenarios, and over the last few years, they did a 300% return. Insane. Let's aim at something a little bit more realistic, which is 15%. Let's say they keep doing 16% revenue growth. I wouldn't be willing to pay a 30 PE. Let's turn it down a bit to 25. Let's say they do 12 here. I would be willing to pay market average PE for 12% growth. That's relatively, it's slightly above market average. So let's go a little higher. Let's go to 20. I think at their size, with their competitive edge, if they manage to grow 12% year on year for the next 10 years, I'm willing to pay a higher exit multiple for that. Now, let's turn this down as well to the same worst case scenario as we did for Mastercard, which is 5% revenue growth at a 10 exit multiple and 50% rate of return. Let's also calculate the yield based on free cash flow. Let's run the valuation. And we actually see similar numbers to Mastercard. I think their current valuation, given their growth trajectory, is about, you're overpaying. You're overpaying. That's it. So it's not a great price. you could consider the price still worthy of investment because they have a massive moat. Their stability, like Mastercard, is very, very high. They're absolutely dominant in the market space. You can't go around them. They have a great business model, really high margins. So yes, even though it says there's a 50% downside, or it's overpriced by almost 50%, you could make a case that it's still a great investment because you're paying top price for an absolutely great business. And that's something as an investor you have to weigh out yourself. Do you think this is worth your money? Yes or no? Can you find a better investment? If I look at myself, I think these companies have made a great run. I think you're overpaying for what they are providing, even though they're great businesses. I think there are better investment cases out there, and I use Marketdaddy to find those cases, and I'll keep doing them. I'll keep you posted. If you want to be part of the ride, you can subscribe to our YouTube channel and stay up to date on everything stock related, and we'll keep you posted on how we value stocks and how we look at stocks through the value investor lens. If you want to play with the numbers yourself, go over to Marketdaddy.ai, try out the software. It's free for 7 days. We believe you will like it, and you can subscribe for a subscription after that. Thanks for watching, and see you in the next one.